This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Jim back on the show. Listeners, you're going to find the download link for the post-game trade of the week in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at macrovoices.com. Just go to our homepage, macrovoices.com, and click on the red button over Jim's picture saying looking for the downloads.
Patrick, you pimped your new Asymmetric Trading Challenge product on last week's show, but how about giving our listeners a solid example of an asymmetric trade design by translating some of Jim Bianco's views into a trade with more upside return potential than downside risk if it doesn't pan out?
Eric, what really jumped out at me in Jim Bianco's comments is that the bond market is not behaving the way a classic easing cycle says it should. The Fed has already cut aggressively, and yet the 10-year yields are higher than when they started cutting. So for this week's Trade of the Week, I wanted to build a trade for those who believe that the bond vigilantes will ultimately prevail. Now, when we had Jim on a few months ago, we expressed his view with a bear steepener of the 5/30s curve. That chart is on page 2 of the deck. Today, I want to come at the same theme through a short, long duration U.S. Treasury position using options. On page 3, you can see the 30-year U.S. government yield chart with a very clear resistance around 5% over the last 2 years. If bond vigilantes reawaken the way we saw with the JGBs or gilts, it's entirely plausible they'll make another run at the 5% level, if not higher. The key to using options here is on page 4. Implied volatility on the TLT long bond ETF is sitting down at its lows of the year. This makes this kind of convex expression much cheaper to put on than almost at any point earlier in the cycle. So I'm looking for a capital efficient, risk-controlled way to profit if yields break above 5%, which is where I think volatility will start to get spicy very quickly. Now, the structure I'm looking at is the July 2026 TLT 85 by 80 bear put spread. We're long the $85 put and short the $80 put, paying about $1.20 for a $5 wide spread. That gives you a better than 3-to-1 risk-reward profile if long yields move higher and the TLT trades down to the low 80s or below, with your maximum loss strictly limited to the $1.20 capital outlay. It's also worth noting that anyone currently long TLT shares on an economic contraction thesis can use the same spread as a hedge overlay. It's a relatively inexpensive way to dampen the downside if we get a breakout in the long end yields that runs counter to the duration bet while still keeping your core long bond position in place.
Patrick, where should our listeners go if they want to find out more about the Asymmetric Trading Challenge?
Eric, we're hosting a one-time special webinar on the Asymmetric Trading Challenge we're running for 2026. We are hosting it on Tuesday, December 16th at 4 p.m. Eastern Time. It is free to attend, so if you want to reserve your spot, go to our homepage, bigpicturetrading.com. You will also find the link in your Research Roundup email. All right, Eric, let's talk about these equities.
Well, Patrick, we got the long-awaited, widely anticipated December rate cut, along with the predictable instantaneous spike higher in the S&P index in a brisk, face-ripping rally that lasted for a good hour and a half before it fully retraced to the downside, and then some, with S&P futures trading in the overnight session below where they stood at 2 p.m. when the rate cut was confirmed. So now the question becomes whether that rate cut will be the predicted catalyst for a Santa Claus rally that takes the S&P to new all-time highs by New Year's, or if maybe it was actually a sell the news event that marks the short-term top just 90 minutes after the cut announcement, and which might not be exceeded again before year's end. Now, only time will tell, but the brevity of the immediate upside reaction suggests that the latter scenario could very well be in play.
Well, Eric, what we've seen over the last couple of weeks has been a complete contraction of realized volatility. This dampening is somewhat to be expected as we've moved far away from trigger points on this market and now approach some key overhead resistance. The key was that so far the market hasn't done any extraordinary move in the post-FOMC period. This puts that jobs number next week in line, but with option expiration next week, if the jobs numbers are not an outlier that causes a big swing in the markets, it's very likely we're going to pin into the option expiration. And at that stage, with the low volume over the holiday period, it's very likely that the rest of the month of December could be stuck in a brutal, choppy trade range, leaving the next major market move to the new year. Let's see if that happens. Obviously, we have a big hurdle to pass with that jobs numbers released next week. But if it isn't an outlier, odds are very high that this is going to be a pretty boring month for the stock markets. All right, Eric, let's talk about this dollar.
Well, the Dixie's not crashing, but it's looking more and more like a short-term top is in, and we're well into a swing trade lower, at least for now. As I've said before, I think the action on the dollar is going to be headline-driven, and Trump and Bessent's next policy moves will likely determine the direction of the next major leg for the dollar. Absent policy action, looks to me like a new down channel is being established on the chart.
Well, Eric, the U.S. dollar has been weakening. We spent 2 months above the 50-day moving average in a retracement that should have even gone as high as 102, 103 on the upside. Instead, the 100 level acted as substantial overhead resistance, and now we're breaking down towards the critical 98 level. And I want to stress, to me, the 98 level on Dixie is real tell, because if we see that the market is interpreting the Fed path to still have a relatively dovish tone, and we give out the 98 level, there's a real chance that the dollar could resume its downwards trend that's been in place all year long. Would that mean a break to fresh new lows? Well, at this stage, we're sort of in a no man's land in the consolidation. The next real major support line for the dollar index was established over the last decade down along the 90 level. So if we see any deterioration in this trend over the rest of December, it could reopen the downside window of the dollar into next year. All right, Eric, let's touch on oil.
Well, it's getting really interesting despite Cushing inventories being at operational minimum. So that means shortage of oil. We should see big backwardation on the front of the curve. We're actually seeing front of curve time spreads softening. That's a bearish sign. So my outlook is unchanged. The fundamentals here are decidedly bullish. I think we're at the beginning of a secular inflation. I think there's lots of reasons, whether you look at the Cushing inventories or lots of other fundamental indicators, that are decidedly bullish. But I also see room for invisible hands to keep oil prices low through the midterm elections. And the Trump administration is very, very strongly incentivized to keep prices at the pumps low through November's elections. Crude seasonal low is normally in February, so I'm definitely not in any rush to put any longs on before then. Now, a dip down to, let's say, $50 WTI would be hard to resist. 45 would be really hard to resist, because I'm convinced that the fundamentals will eventually carry this market higher. But right now in the high 50s, the question in my mind is how long the Trump administration can delay that inevitable outcome of a move much higher in oil prices. And I think the answer is probably quite a while. Time will tell.
Really, there's no other way to put it. It's been an incredibly boring trade range. Now, there's been no momentum breakdowns. Usually when you trade this way below a 50-day moving average, there should have been easily a breakdown to 55 or even down towards 50 with this type of price action. But instead, it's been a consolidation sideways. It's almost like oil has found a new fair value zone. And while there's no catalyst to take it higher, it doesn't seem to be in any rush to break down. Now, obviously, some sort of a news catalyst will likely break this trend. I want to observe that the prevailing downtrend is the dominant one. There has simply been zero sustained buying at any point, but it is a consensus trade to be short. There's very little interest in this, and all CTAs are positioned on that short side. So if whatever catalyst was ever introduced to create a short squeeze, it can certainly be the pain trade that emerges emerges on the market. But right now, there's zero technical evidence of that. At this stage, this might be the story of continuing sideways for the rest of the month. All right, let's jump into gold.
Well, the rally in gold after the Fed cut lasted much longer and didn't retrace nearly as hard as the retracement in stocks. The short-term overbought signal is being shaken off by time rather than price, with a sideways price consolidation for more than a week now, causing the slow stochastics to retrace back down to about half-mast. So I think the rally toward new all-time highs is probably on, but there's still plenty of room for more consolidation before the next big leg higher begins.
Well, gold is trading a stone throw away from its 52-week highs. It's been very well accumulated, holding up there, and maybe in this post-FOMC period, and especially in the post-jobs number period, maybe gold will have the tailwind to potentially break out to a fresh new high. This will be yet to be seen. I think I'm going to reserve my market call on this next week when we're post that news. But it is noteworthy to talk about silver, which I have on the chart deck on page 10, and what we see is a continued parabolic rise in silver prices. We've now hit $62, which is a basic measured move target, but there's a bigger measured move that is all the way up to the $70 mark. This is clearly being very well bid. Every little dip gets bought. Consolidations are sideways, and breakouts to new highs happen almost immediately. This is a market that continues to take flows, and it's certainly giving a bullish tailwind to all four of the precious metals. All right, Eric, let's touch on uranium.
Well, as I said more times than I can count, I couldn't possibly be more bullish about the long-term fundamentals for uranium and for nuclear energy generally. And while this consolidation has been a little bit frustrating, the weekly chart's really starting to look great in terms of oversold stochastics setting the stage for another big leg higher. The sticking point has been the spot price of uranium, which was stubbornly unchanged for more than a week, but which is now finally, as of Wednesday's trading action, just barely started to tick up. Let's see if we can sustain a rally in the spot price, because that's what's going to give the next leg up for the miners.
Well, Eric, when I'm looking at these pullbacks in the uranium stocks and in uranium itself, we've now seen that overbought state get completely unwound, and in some cases, some oversold readings coming out on the markets. We've seen already a 50% retrace of the rallies. So the asymmetry has reset in the uranium markets. The bigger question is, does it start on the upside in a big way here in December, or is it going to be a January story? Overall, the very overbought state is gone. And so now it's just really about setting up where could a potential new bull breakout really get underway.
Patrick, before we wrap up this week's episode, let's hit that 10-year Treasury note chart.
Finally, Eric, just touching on that chart on the 10-year yield, and what we have seen over the last 6 months was a sequence of lower highs and lower lows as the yield worked from the 460 level all the way down temporarily below 4%. Now we have seen that pattern slightly change. Majority of that decline, the yield stayed below their 50-day moving average, just simply depicting the trend of lower rates. We have seen that descending trend reverse here. And so this is the first time in half a year that we've seen a higher high on yields. The bigger question here, is this a turning point? Is this where we're going to see that 10-year make a push back to the highs where it was earlier this year? That's the puzzle to solve. Certainly, this is the first time the price action has pivoted this way. Let's see whether or not the jobs numbers really shake up this 10-year to follow through on the upside.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests, and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.